Kia Political pressures in the US Federal Reserve have reignited the debate on central bank independence, from President Trump's public criticisms to concerns over the Fed's quantitative easing policies. These tensions risk undermining the credibility of one of the world's most influential central banks. For a small open economy like New Zealand's, such credibility shocks can spill over rapidly through the NCD, bank funding costs, and mortgage markets, challenging our financial stability and testing the strength of our own institutional framework. Now, with the question you can see on the screen, the Governor of the Reserve Bank of New Zealand will outline how the bank's OCR and liquidity tools can maintain price and financial stability in this environment.
Imagine waking up tomorrow and finding out your country's central bank has to ask politicians for their permission before making decisions that affect your life. How stable would your economy feel then? I'm Kashik, and I'm here to explain why central bank independence matters. When politicians interfere with the monetary policy, credibility vanishes. The decades of trust established by the central bank tends to evaporate, and markets start to panic. Griffin and Cascio tell us that President Trump's public pressure on the US, the Federal Reserve raised inflation expectations and long-term interest rates, repeating the past chaos of the 1970s, leading to runaway inflation. Economist Lawrence Summers also talks about when independence was lost, and that investors stopped trusting central banks to make evidence-based decisions. However, independent central banks can make tough, unpopular decisions. This might mean that they may have to tighten the monetary policy to manage inflation without having to worry about public backlash. Credibility becomes the economy's anchor, and if we lose that anchor, it will take years to rebuild the trust again. That's why protecting the central bank's independence isn't just about smart economics, it's the foundation of financial stability.
Thank you for those insights, Governor. Now, the CEO of a major New Zealand bank will discuss how higher global loan rates could affect bank funding costs and lending.
Well, higher global long-term rates lift our funding cost almost immediately. That pushes up lending rates and squeezes our net interest margin, as deposit costs rise faster than low yield. The high yield will reduce the value of our bonds holdings, putting some pressure on CET capital. We also need to hold more liquid assets to meet LCR and extend funding maturities for NSFR, which aids to our cost base. Mortgage and SME lending rates will rise as we pass on higher funding costs and manage tighter capital and liquidity requirements. The political entanglements between the Trump administration and the Fed serve as a cautionary tale. The cabinet should prioritize the operational independence of the central bank to uphold market confidence. High public trust in the central bank can stabilize inflation. This assists in better prediction of interest rate, which helps us to maintain credit supply to households and businesses.
First, I'll turn to the chief economist from the Treasury. How can fiscal and monetary authorities coordinate effectively without compromising the Reserve Bank's independence?
Kia ora koutou. Great question. The US debate on quantitative easing is a wake-up call for every treasury. When interest rate hit zero, the Fed reached for unconventional tools, massive bond purchases to lower long-term yields and keep markets alive. But Scott Bessent warned that this is a gain-of-function experiment. It worked for price signals and inflated assets, while Karen Patrol called it the socialism for investors and capitalism for everyone else. But Paul Krugman pushed back, saying that QE wasn't reckless. It was the only lifeline left when the fiscal policy was frozen. The real danger isn't the tool itself, but political meddling that weakens the central bank independence. And that's the key lesson. Once politics seeps into the monetary policy, the markets lose face fast. Here in New Zealand, our guardrails work. Treasury anchors fiscal discipline and debt management. The RBNZ runs monetary policy through the OCR, and when needed, temporary LSCPs independently. So we coordinate, but we don't co-pilot. Unconventional tools can stay to markets, but only when discipline and independence stay intact. That's New Zealand's strengths and our responsibilities. Thank you.
We strongly appreciate the perspective from banks executives. Finally, our global market strategist will explain how markets interpreted these developments and what guidance could help stabilize the NCD and long-term yields.
From an investor's perspective, three variables shape how New Zealand is priced in global markets: the exchange rate, term premia, and confidence in RBNZ's credibility. When the credibility is strong, risky premia stay low, and the currency remains stable. But when major banks, like the Fed, face political pressure or credibility concerns, investors demand higher compensation for risk worldwide. That widens global term premia and raises New Zealand funding costs, even if local conditions haven't changed. Clear and consistent communications from the RBNZ showing decisions are data-driven and independent reassures investors, keeps inflation expectations anchored, and helps contain volatility in both New Zealand dollar and bond markets.
Today's discussion highlights that central bank independence is not merely a theoretical concept. It is the foundation of economic credibility and stability. While the US faces renewed political and policy challenges, New Zealand's institutional safeguards, a clear RBNZ mandate, transparent coordination with the Treasury, and disciplined communication to ensure that our monetary framework remains resilient. Thank you very much.